Good morning, everybody, and thank you for taking time out of your busy day to join today's call. We really do appreciate it. While we're waiting for a few lagging attendees to perhaps log into the call, I'll take this chance to introduce myself. For those of you who I haven't had the pleasure of meeting, my name is Chad Carlson. I'm the Senior Portfolio Director or Portfolio Manager of Boulay, and I work with John Nylander, our CIO, and the rest of our advisory group to structure the portfolios that we have you invested in. I'm really looking forward to today's call. I think it's prescient, timely, and should be a good educational source for all of us. And so with that being said, coming to us live today from San Antonio, Texas, is Wasif Latif, Head of Investments from Victory Capital. Wasif has 20 years of investment management experience. He can be found from time to time on CNBC, and he's even a frequent contributor on Fox Business News as well. He's responsible for leading the investment management function across Victory's solutions platform, including multi-asset funds, target risk funds, strategic beta ETFs, and multi-manager equities. So as you might imagine, with a resume like that, he's probably more than qualified to speak to us today about any asset class. Unfortunately, for time reasons, we're probably just going to have to focus in on the fixed income sector today. So before we break into the call, I'd like to lay down some logistics. Your screen should have a little Q&A session in front of you. We encourage you to ask questions, and I will do my best to compile them throughout Wasif's presentation today. And there will be a time for us to address Wasif with any of these questions at the end of the call, and we'll do our best to pick his brain at the end of the call and maybe glean a little bit more wisdom for us. So with that, Wasif, I'm going to turn it over to you, and we'll go from there, I guess. So I'll give you a chance to tell us who Victory is and what it is you do.
Thank you, Chad. Good morning, everybody. Really appreciate your time to join us this morning. As Chad mentioned, investments for Victory Solutions, and Victory is an asset management with a multi-boutique structure where we have a variety of different teams that are managing different structures, different portfolios with under $150 billion in assets. And you can see a few different products, including fixed income, equities, and different types of products like ETFs as well. You go to the next slide. We run a variety of different strategies, and today we're going to talk a little bit about income portion of investors' portfolios. We manage asset allocation portfolios, which include balanced stock bond portfolios, and as you can imagine, the 60-40 with 60 stocks and 40 bonds that has seen great degree of success over the past few years, benefited from the fixed income allocation, the equity allocation over the past decade or so. If we skip to slide 5, we can jump right into it. So historically speaking, the purpose of fixed income in a balanced portfolio, a mixture of stock and bonds, has really been, and we came up with these 3 icons to reflect that. So one is to provide level of yields, so a decent amount of income coming out of that vehicle. Provide low correlation to stocks, so that when stocks are zigging, then fixed income can be zagging, and provide that diversification benefit that has those type of balanced portfolio decades. And then last, fixed income characteristic generally, historically, has had low levels of volatility. It's some in your balanced portfolio, providing some of the stability in the portfolio, the equity volatility. So if we look at the table below, we can see 3 components broken down by yield, where the income is, and we use the Barclays Bloomberg Ag Bond Index. It's basically an index of the broadest collection of investment grade fixed income around the. And as you can see, yield on the income portion coming out of that index has been fairly attractive over the decades, And over the past 1 year, it's been about 2.3%. So it has come down. As we know, the interest rate environment has continued to come down, and so yields are a little bit lower than what they used to be. But over history, they provided attractive yield. And then looking at the second box, which is the return portion, we can see that the return portion of the fixed income part, which is the row, the same index, the bond index, has provided good income overall, good return, total return overall over that time frame. So if we go all the way to the right, either on the 10 column or the 40-year column, we can see that fixed income has provided a return, especially looking at the 40-year column on an annualized, that's been very strong. Needless to say, the yields right now are fairly low, so it may not be looking like that going forward for us. And I'll get into that a little bit in the next slide. And then looking at the equity side, we can see very strong double-digit annualized returns when we compare the S&P 500, and that also helps provide some of the complementary relationship between stocks and bonds from a return perspective. And then secondarily, the third box at the bottom is the standard deviation. What is the volatility of the stock portion or the bond portion of the portfolio? Said earlier, if you look at the top right, that icon showing that fixed income generally has had low levels of volatility historically, we can see that all the way at the last row, that the volatility or the movement of the price over an annual given period has been fairly stable, with about 3% range on an annualized basis going back many, many years. Compare that to stocks, which generally tend to have a lot more volatility, and we can see that with the double-digit levels of volatility is going backwards. So far for the past few years, the volatility has been on the upside for stocks. That's been great, and investors enjoy that, with the exception of the sell-off that we saw last spring. So that's sort of the historical role that fixed income has played in portfolios, especially in portfolios that are balanced with a combination of stocks and bonds. If we go to the next slide, it shows some of the reason behind the really strong returns that we have seen in fixed income over that period. And the way I wanted to illustrate that was to show the yield on the 10-year US Treasury note. So this is a line that is showing at any given point in time. As you can see, this chart goes back all the way to 1962, showing the yield or the return investors could have had over a 10-year period had they invested in the 10-year Treasury yield at time in history. And as you can see, the yield line has been steadily coming down over the past 40 odd years, pretty much early 1980s, when, as some of you may recall or know from our history, that when inflation was running fairly high and there was a lot of concern around inflation, bonds were underperforming and yields were rising. And when Paul Volcker raised the Fed's interest rates in order to tackle inflation and was able to defeat inflation, which created an environment for bond yields to step as productivity increased. So the way the bond math generally works is the yield is basically, especially on your treasury or any kind of treasury market, whatever is the starting yield that you may have today is most likely the return you're going to experience in that security for that period of time. What do I mean by that? I mean that on a 10-year treasury note, whatever is the starting yield today, if we were to buy a 10-year treasury today, our starting yield today would be the return we would experience over that 10-year period until maturity. In the intervening periods,
Wasif, to reinforce that thought, so if we go back to that previous, you're saying on today's aggregate bonds, we've got that 2.3% yield. So to reinforce the thought process, you're saying we should expect 2.3% roughly over the next 10-year time frame. Is that what you're saying?
That's right. So, you know, bond math is actually fairly, it's it's not as much of the rocket science or the sort of the moving parts and variables that may come in equities and pricing equities going out into the future. With bonds, it's relatively more straightforward, and you're right. So with that yield line all the way at the bottom, and this is the 10-year treasury, so you can expect a high return if you were to invest in the target index that we looked at page, but they're still fairly low. So this level that you're seeing here is at about, it's picked up a little bit since the beginning of the year, so it's at about 1.1, 1.2%. And then if you add on an extra little bit of return, the aggregate portion or investing in corporate bonds, you could get a little bit more. But it's fair to say, given starting yields, the outlook for bonds is muted, and the expectations are they're going to provide the kind of return that they have had in the past. So if we go to the, excuse me, before I move on, I also wanted to point out the other thing to note about this slide is if we look to the left, a period where we ran higher levels of deficits in the budgets of the country, we had higher levels of inflation, which initially was good and positive inflation. Nonetheless, it impacted yields on the bonds, and the yields went up. And interest, you own a bond and the yields subsequently begin to rise, then the price of that bond inversely impacted by that. And so there is a inverse relationship with yields. As yields rise, the prices of bonds decline. And when yield, as this line shows from 1980 onwards, the prices of bonds appreciate. So if we are once again in an environment where the best case scenario is we're going to achieve low levels of income and low levels of yield within fixed income, and a more different or a more difficult scenario would be if the yields began to rise on concerns around inflation or just a recovery in the overall economic environment. And in that case, if the yields rise, the bonds would react negatively.
So maybe I'm stealing your thunder here, Wasif, but you know, we had let's just call it a huge drop in rates back in March when COVID first hit, and we saw, you know, yields just absolutely collapse, especially on the treasury markets. Do you think that was, you know, in your opinion, we're not going to hold you to anything here today, but do you think that was the low in rates that we see, and we should be expecting? I see a couple questions floating through on the board here about inflation and inflation expectations. And as you talk about what I've always termed the bond teeter-totter, when interest rates go up, bond values go down. And when interest rate values drop, bond values go up. And or interest rates yields drop, bond values go up. And so coming off of the crisis that we saw last March and everything else, in your opinion, do you think that is an environment that are we at risk of moving into that, let's call it the 1970s style, I don't want to call it stagflation, but that sort of environment in the near future in any way, shape, or form?
Sure. Yeah, that's a really good question. So I would say the big drop that we saw in interest rates last year was indeed driven by the pandemic and the crisis in the market. And there is the possibility that we saw in which was about 0.5%, so 0.5% yields roughly on this 10-year treasury may have been the bottom that we saw, and yields begin to march steadily upwards. If we do see economic recovery and a return to normal of life, economic activity in the post-pandemic environment. So that's indeed the case. Now, Does that mean that the yields start rising very, very rapidly in response to higher levels of inflation, given the concerns around the high levels of deficit? That is certainly possible. Although the gap that needs to be filled in terms of how much productivity is not there and the unemployment is there, it may be some time before we get there. But indeed, the trajectory we are on with a higher level of deficit spending, not only from monetary standpoint, but also from a fiscal standpoint with the fiscal packages coming, which are important right now to support the economy, but ultimately could lead to higher level of inflation, which would push these yields even higher. And the interesting thing is, as you can see on is when they start moving up and there begins to be greater degree of around inflation and the expectations rise, those rises can be pretty rapid and violent. So it may take us a while before we get into that situation, but if we do, then you could see rapid yields and therefore, to your example with the teeter, if yields rise, then bond would go down.
Sorry, I didn't mean to interrupt the flow of the conversation. It's just something that.
No, this is great. I appreciate it. That's a great question. So if you go to the next slide, this is just a comparison between that 10-year Treasury yield compared with the aggregate bond, so the Bloomberg Barclays Ag Index that we would generally invest in, which is in that pink line. What we also did was we threw in the dividend yield of global stocks. And there are periods in which where dividends actually provide a greater income than traditional fixed income, like now, especially compared against treasuries, but also against the aggregate index. And as a result of that, dividends are offering a really strong level of income, and investors can enjoy that income in their portfolios without having to invest in bonds and move that into dividends. Well, as we know, if we go to the next slide, you can look at some of the different options that we have as investors. And we face this scenario in our own asset funds for our investors that we invest in. What are our choices when it comes to investing in income products? When we look across the yield spectrum of all of the different things we can invest in, whether it's the 10-year yield, the S&P 500, the broad U.S. market, or the Barclays Ag Index that or even the corporate bond index, which pays a little bit more, all the way to the left, showing yield on global stocks. And when you factor in global equities, which includes some non-U.S. Companies that are really strong, high dividend payers because they have a culture of dividend income in some parts of the world. You can get investors can see a greater degree of income from their stock portfolio from their dividends. However, as we saw earlier, stocks inherently have volatility attached to them because they're in a volatile asset class. So you want the income, but you don't want the volatility. So how do you get to eat your cake? You can eat it too. And one way to do that is to alternative type of investing, where in a strategy similar to what we do in one of our strategies, which is to invest in the highest dividend stocks globally, but then turning around and shorting or negating the impact of the market by selling some of the stock market, broadly speaking. So what you end up with is a stripped out version of a income stream from the dividend. And that type of a strategy generally doesn't seem to have the volatility that comes with stocks, and it actually isn't correlated to stocks as much. And I think if we go to the next slide, we only have a couple more slides left. So this was the whole idea, that how can you invest in dividend yields without the concern around the volatility that comes investing in stocks, because we know that the starting yields on fixed income are low. And so how do we capture that? So I think the next slide is my last slide where I talked about, can we invest in equities to capture the dividend income and not have the volatility? And so there are alternative type of strategies, like a strategy that allows for dividend income, which is a decent income. As we showed, the higher level of income that comes in from capturing some of that dividend, especially on a global basis, and then be able to sell the underlying market and provide a portfolio that gives you good income and low into stocks and bonds. And it's a good way for investors to continue to have an allocation to something in their balanced portfolio, especially in light of what may be coming down the horizon for fixed income type of portfolios. So it's a good way to diversify out of fixed income and that this type of strategy within the portfolios. And we have done so in our strategies as well. So with that, I'll stop, and I would love to answer any questions or see what thoughts there are.
While I wait for a few more questions to roll in, I'll just toss this out. So as we kind of look at your presentation, Wasif, we're at really low yields in basically across every fixed income sector. Obviously, bonds, we just covered it earlier, they work like a teeter-totter, where yields drop, assets go up, values go up. If yields go up, we go down. And so we're currently in an environment, if I hear you correctly, where we're not getting paid a whole lot for those fixed income or the fixed income products.
Correct.
And we have risk of actually a decreasing asset on a go-forward basis. Am I safe in my assumption so far throughout your whole presentation?
Yeah. So as I mentioned earlier, historically, bonds have given good income and they've provided stability. The risk is that going forward, they do neither, that the level is low. So the yield income level is not as attractive as you'd like. And then the risk of volatility, because if it then the would be at risk. So your teeter-totter, that would be the opposite of what bonds have done up until now for the last 40 years.
And so therefore, on a go-forward basis, we probably, we've gotten used to this world where, we have a quote 60-40 portfolio, and that 40% has always been fixed income, and we've become almost reliant on the fact that fixed income is a stable portion of our portfolio. But if we go back to one of your previous slides, you're saying we don't know if we're there yet, but we may be soon. Maybe it might be a couple of years out. Who knows? Like you said, there's still a lot of room within the capacity of the economy before we hit any sort of inflation. But we may be soon entering that. Now, I wasn't around in the 70s. I showed up on the screen about 1978, right? And so I didn't experience that market. But what you're saying is we may be getting closer anyway to that sort of environment. And so what has worked for the last 30 or 40 years within a 60-40 balanced portfolio probably isn't going to work on a go-forward basis let's just say over the next 10 years. Is that a safe assumption?
Yeah, I think it would be. And as you said earlier, not only is that the risk, but the yields are low. So you're really not getting that income. So it's the reverse of what fixed income has provided over the past 40 years.
So while that doesn't paint a good picture for fixed income, I don't think it's a revelation to any of us who work in the investment industry, or probably any of our clientele who pay attention and care about this stuff on a day-to-day basis. And so with that being said, you talked about the product that Victory has mentioned, and our clients are probably familiar with that. That's that Victory Market Neutral Income Fund, which is basically built a collar around a few different high dividend paying indexes, and they're getting the income off of that. And the reason that they're seeing that in their portfolio is because of the environment that we're in. That's a current, at the moment anyway, a better paying option than most of our fixed income. And we really don't have that downside risk of if rates do go up, we're not going to get hammered as far as the assets. So, and it has similar volatility to the aggregate bond index throughout time. So I don't know if there's anything more that you want to say on that victory market neutral income holding at all. I can open that up to you and let you explain that a little bit more, if you want to take some time to do so.
Yeah, so as an investor, I like that strategy, and as I mentioned earlier, we strategy within our balanced portfolio. So if you think of the 60-40, we've carved out the 40 and allocated money to that type of a strategy. And as I mentioned earlier, what it does is it will buy the dividend paying stocks around the world to get a good solid income. And then it then turns around and sells the underlying market. And so what you're left with is none of the market exposure and all of the income that comes from dividend income. And what I like characteristics as an investor, number one, I get to enjoy good current yield. Number two, I get paid to wait on the risk that bond yields begin to rise. And so I don't have to worry about that portion. And then number three, that investment is not correlated to stocks or correlated to bonds, and it's a independent moving investment that will continue to provide that income that I would need anyway in my portfolio.
So we still get the income and diversification that we are used to within the fixed income component of the portfolio. It's just maybe we don't get the upside fluctuation and the appreciation that we've been experiencing for the last 40 years as rates have gone from wherever they were, 14% back in the 80s or the 80s down to where they are today.
Correct.
Is that a safe assumption? So
yes.
Okay, well, we paint this picture of the fixed income world and where we're at, and like I said, I don't think that's a revelation to anybody. In historical reading and things that I've researched, I've seen it said that in the 70s, one of the better diversifiers within a portfolio was the commodity sector itself. And because throughout that stagflation time period, you would see
yes.
equities drop and fixed income drop, much like what we saw last March. And you would see both of them drop at the same time. But what actually provided the stabilizer within the portfolio was the commodities complex within the structure. So in your multi-asset structure portfolios that you're in charge of, have you been adding any sort of commodities exposure or anything like that? Like, gold is the first one people think of, but there's right. Oil. Oil took a beating here throughout all of 2020, and the Biden administration doesn't look too positive on it as they're moving to a little bit more of a green agenda. But what are your thoughts on commodities as far as a construct of the portfolio at this point?
I love that question. That's a great question. And so to specifically some of the questions you had, we invest in those type of investments in our strategies. We like commodities. We have an allocation to broad commodities in our asset allocation portfolios. In addition to that, we also have a allocation to precious metals or gold within our portfolio, part of the alternatives component as well. And these investments provide a couple of different results for us, which I can go through. Number one, they provide diversification, like they have historically, because commodities generally tend to move differently than stocks and bonds because of their own supply and demand dynamics based on what's going on with the real economy or around any kind of policy impact with the price of gold. Secondarily, with the world looking at the post-pandemic environment, and for the first time in almost 20 years, over 15 years, the global economic environment seems to be synchronized in that all of the major economies of the world are trying to reflate their economies simultaneously. So whether it's Europe, Japan, China, or the US, everybody is trying reflate their economy through monetary policy and through fiscal policy, which hasn't happened in a long time. Even post the financial crisis, it didn't happen. And as a result of that, not only we are likely to get higher inflationary pressures, we are also likely to get higher commodity demand based on pure economic rebound that may be occurring globally as people begin to thaw out and come out of the pandemic, but also trying to grow and build in the future. And then lastly, these type of investments tend to hold up better in the portfolios because of that component of income, because of that component of diversification that they provide to the portfolios. And so we have an allocation to that in our portfolios, and we think that given the risk of rising rates or the risk of inflation, these type of investments may add value to the portfolio. Chad, you're on mute.
Sorry, I said earlier in our pre-meeting, I felt like I was driving a 747 here with all the controls and their various screens I've got going on. So my apologies to the viewers of the call. I've got a couple calls here or questions here in the queue about, one of them says I have a majority of my fixed income investments in floating rate and short duration assets. I'm targeting fixed rate durations, but have been hesitant to adjust with rates so low. What would you recommend? So let's just focus in, if all you're willing to invest in within the fixed income world is some sort of fixed income, where is the best spot within the fixed income complex
Sure.
in the current environment that we're in?
Yeah, I think that's a really good point, where in floating rate bonds in a right environment is an attractive proposition. And we also have a floating rate strategy that we use in our portfolios as well that does some of that. As you know, floating rate bonds are kind of like an adjustable rate mortgage, if you will. As rates rise, the yield or the rate resets on a regular basis. But it's on the flip side, because as an investor, you enjoy that yield because you're collecting it. So as interest rates rise, that yield will automatically adjust upwards in periodic periods to reflect that. So that's an interesting investment in that period environment as well. The other one is, as I mentioned, is short duration portfolios. So when we think about fixed income, there are varying maturities in fixed. Some fixed income is some bonds within a few years, all the way to 30 years, or some are even longer than that. The longer the maturity is, the greater the interest rate risk because of all the length of time to. So the bottom line is, the shorter maturity type investments in fixed income in a right environment may tend to do better because you're not as subject to the volatility of. So if rates rise, then the price of your bonds may not be impacted as much. The drawback is you're not going to get much income because the income is already very low, even in the 10-year bond. So if you went shorter maturity or shorter duration into, call it a 1 or a 2-year or even a 3-year bond, then the income you're collecting isn't much to write home about. And that's the drawback of that type of an approach.
Okay. One of the questions we're getting here too, and I'm curious of this, is, most investors sit in a 60-40 portfolio, and this gets into risk characteristics and everything else. But in the current environment we're in, do you think it's wise to step up and be a little bit more aggressive and have a little bit more equity exposure than what you traditionally have within the fixed income market? Going from a 60-40 portfolio to maybe a 70-30 portfolio,
right?
If we're using those labels still.
Sure.
Would that be a wise, obviously every investor has their own risk characteristics and they go through that with their financial advisors and so on and so forth. But given where we're at in the world, do you think that would be a wise thing to at least have people discuss with their financial advisor at this point in time?
Yeah, so I've been investing in these types of balance portfolios, running different risk profiles and characteristics for over 20 years, almost 23, 24 years. And, I can just say from my experience is that switching the risk profile to increase your stock allocation or decreasing it is really a preference on risk. And so if you have a greater degree of appetite for taking on that risk, as we showed earlier on, the volatility of stocks is still very high. So stocks inherently are a volatile asset class. So if your risk profile can stomach that and you're okay with that type of volatility, then that could happen. I would say that increasing your stock allocation as a substitute or in lieu of bond returns may not be the same thing, because you're inherently taking on more volatility risk by increasing the stock portion. That's why in our portfolios, if in our investors, if they are invested in the 60-40 portfolio or the 70 portfolio, our job to provide them that exposure. And what we're doing within the 40 of the fixed income is trying to diversify and create a bucket of alternatives that can help provide some of that rising rates and not necessarily additional equity risk in their portfolio.
Thank you. So it really boils down to, hey, don't go chasing yields. It's still an aspect of how much can an investor stomach within their portfolio. Is that safe to say?
Yes. Low yield environments induce investors to chase returns, but as we know, the greater the return potential, there is the higher risk of volatility or downside, and that needs you need to keep that in mind as you do stretch out for that greater return potential through increase.
Well, the questions have slowed down here, and we appreciate your time. Maybe as just a parting shot, we'll step away from the fixed income world and look at maybe our final question. It's a question that I'm curious of as well. I'm not sure who pushed it out there, but effectively, is China, or let's just say Asia, the future growth of the world, and should we be taking a closer look at that part of the world with our currently constructed portfolios? Historically, everybody has a home base asset. Sure. Americans like to invest in American stocks, and Japanese like to invest in Japanese stocks, and we know that. But if we're smart about it, should we really be taking a closer look at China or parts of Asia at this point in time?
Yeah, I think that's a great question, especially out into the future. The quick answer is yes. And the description is that there's a chart that I usually show. It's not in this deck because this is a fixed income focused deck, but it shows the different regimes over time, how the various equity markets around the world have moved over time. So in the early 1990s, emerging markets had such a strong return that they returned over 500% over that period, above and beyond what U.S. equities did. But in the late 1990s, they underperformed significantly, and the US outperformed. Then in the following decade, from 2000 until around 2012, emerging markets significantly outperformed, and international markets outperformed the US markets. And being US centric would have impacted your portfolio, or detrimentally impacted your portfolio, whereas having that diversification and that allocation to those markets would have helped. Second, now in the most recent decade, the U.S. market has outperformed and only emerging markets have underperformed. We think that going forward, we may be getting into a cycle where the non-U.S. markets begin to outperform. So in terms of timing, it's probably a good time to rethink the equity allocation regionally and increasing the allocation to emerging markets in particular, because Asia is the strongest and fastest growing global. The demographics, the growth rates, the consumption favor long-term growth in that environment. And lastly, with all of the reflationary activity, especially within the U.S., with the Fed being weaker dollar policy, that would be helpful in portfolio exposure market, because that environment. And we think that we may be entering another regime like we saw in the early 90s or in the 2000s, where non-US markets, especially emerging markets led by Asia, outperform.
Well, we appreciate that. We appreciate your time here today, Wasif. I don't know that there's any more questions that we're probably going to be able to get through here today. I know we're up against some time barriers as well. So we appreciate you coming on and giving us an overview of kind of a historical look of the fixed income marketplace. and why our clients are probably seeing that victory market neutral income fund within their own portfolios right now. And then giving us a few, just allowing us to pick your brain here in regards to what's going on in the world and how we should be thinking about our portfolios on a go-forward basis. So with that, you see on the screen in front of you, we've had portfolio discussions today, but the portfolios and everything else is only a part of what we do here at Boulay. We do try to manage and help you with your whole financial planning process as well. So if there's anything that you have questions about, don't hesitate to reach out to me or any one of our Boulay members today if there's a way that you think you can help us. So Wasif, again, thank you very much for the time and effort that went into this call. And with that, I think we'll sign off. Thank you very much, everybody. Talk to you later.